We've spent years debating market cycles, but looking at the macroeconomic landscape of 2026, we are past the point of cyclical debate. We are in the middle of a forced structural realignment.
Exactly. Everyone celebrated when we averted the 2025 fiscal cliff. The Our Borrowing, Budget, and Balance Act, the OBBBA, stopped a $4 trillion tax hike, but the trade-off was brutal. We essentially traded immediate stability for long-term fiscal insolvency.
And the numbers from the Congressional Budget Office confirm it. We're looking at federal deficits swelling by over $5 trillion in the next decade. Net debt is pushing past 100% of GDP, and interest costs are now outpacing national defense. But it's not just a federal problem, is it?
Not at all. Look at the Chicago Regional Transportation Authority. They're facing a $730 million shortfall. It's the ultimate canary in the coal mine for G7 economies. Local revenues are drying up because of remote work and the end of pandemic aid. The government has two choices: cut spending by 5% and trigger a hard landing, or inject more liquidity.
Which brings us to the most critical variable of this decade, the transition from fiscal consolidation straight into monetary paralysis. If the government tries to offset these deficits with massive spending cuts, we're looking at a 2% GDP contraction.
And that forces the Federal Reserve right back to the zero lower bound. It won't be a policy choice. It will be a necessity to stop a systemic collapse. We are entering a true Keynesian liquidity trap. Central bank liquidity just gets absorbed into excess reserves instead of stimulating credit.
So in that environment, government bonds and cash become perfect substitutes. The traditional bond as a safe haven trade is essentially dead. If monetary policy can't anchor inflation, institutional allocators have to find a new off-ramp.
Precisely. You have to shift into high elasticity assets that bypass a broken banking system. And in an era of fiscal dominance, Bitcoin is no longer a speculative gamble. It is a mathematically verifiable proxy for broad money supply expansion.
Curious, let's break down that math. You're looking at a specific elasticity model to ground this, right?
Yes, our log-log co-integration model. It proves Bitcoin acts as a massive liquidity sponge. The core number to remember here is 2.65. Historically, a 1% expansion in US M2 money supply drives a 2.65% increase in Bitcoin's price. It's a structural relationship, and there's a built-in margin of safety. About 12% of any price dislocation self-corrects on a monthly basis.
Slightly animated, but we are seeing a massive dislocation right now. The 2025-2026 Great Divergence. Global M2 expanded by 12%, but the Fed was shrinking its balance sheet through quantitative tightening.
Right, a massive tug of war, and it created the biggest valuation anomaly we've ever seen in digital assets. Based on the M2 expansion, our model puts Bitcoin's fair value at $136,000, yet spot prices have been languishing near $74,000.
Emphasizing the point, that is a 46% structural discount.
Exactly, driven by two shocks. First, the yield shock. The 30-year Treasury broke 5%, making non-yielding assets less attractive. Second, the flow shock. We saw massive liquidations from spot ETFs as institutional money rotated into AI equities.
Which really forces us to look at the narrative around Bitcoin. Institutional allocators need to completely abandon the digital gold fallacy, don't they?
They have to. Bitcoin does not cushion drawdowns during market panics like physical gold does. It amplifies them. Its sensitivity to liquidity is 19 times greater than gold. Look at MicroStrategy. Their corporate treasury leverage caused their shares to drop 60% from their peak. Bitcoin is the ultimate liquidity barometer, not a volatility hedge.
So let's give the listeners a playbook. We're staring down the 2026 fiscal cliff. What is the tactical response for the institutional allocator?
It's a two-phase approach. Phase 1 is the shock. Anticipate more forced liquidations as the market tests that $60,000 floor.
Interrupting gently, and phase 2?
The decisive pivot, the non-negotiable. The Fed will be forced to abandon quantitative tightening and shift to large-scale quantitative easing to break the credit deadlock. That is your catalyst. With a 46% valuation discount, allocators should aggressively position for mean reversion. In a world where the bond hedge is dead, Bitcoin is the premier tool for capturing the inevitable expansion of the global money supply.
If the economic models suggest Bitcoin's fair value is $136,000, why is the market still languishing at 74? This is Podslice Daily Hacker Bites. I'm Paul, broadcasting from London. Today, we're dissecting the 2026 fiscal cliff, with the OBBBA, the Our Borrowing, Budget and Balance Act, pushing federal deficits toward $2 trillion. The bond as a safe haven trade looks increasingly terminal. Is Bitcoin the ultimate escape hatch, or just a high beta trap? We'll start with Sam in New York.
Yeah, thanks, Paul. Look, everyone's, they're missing the forest for the trees here. The CBO is projecting net debt at 101% of GDP this year. That's post-war territory. We have this 2.65 elasticity model now. It's literal math. For every 1% the M2 money supply expands to cover these deficits, Bitcoin moves 2.6%. It's not a speculative coin anymore. It's a high-powered barometer for the inevitable debasement.
A mathematical certainty? Elena in Zurich, you've been looking at the volatility metrics. Do you buy Sam's liquidity sponge thesis?
Not entirely, no. I mean, Sam, you're ignoring the great divergence we just saw. When the 30-year Treasury hit 5%, institutional capital didn't run to Bitcoin. They ran to AI equities. We saw 2 billion exit the BlackRock spot ETF. The data shows Bitcoin's conditional mean return is negative 2.8% during S&P stress. It's not digital gold. It's a high beta extension of global liquidity. When the VIX spikes, it tanks.
But the VECM coefficient, it shows a 12% monthly mean reversion. It's a gravitational pullback to fair value. The gap is 46% right now. That's like a massive signal for anyone with dry powder.
Dry powder doesn't help when the services-led inflation is stuck at 71 on the ISM index. If the Fed stays tight while the Treasury stays loose, you're in a credit deadlock. Bitcoin is the ultimate liquidity barometer, sure, but that means it's the first thing to get sold in a crunch.
A fascinating divide. Sam sees a structural realignment tool for a decade of fiscal dominance, while Eleanor warns of the reflexive risk in a liquidity trap. My thanks to both of you for joining the debate. That concludes our look at the 2026 macro nexus. I'm Paul, and this is Podslice Daily Hacker Bites.